let's look at AYRO because there could be a really interesting opportunity today. So first off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So AYRO, this is the company's website, driving the future forward. So they design and produce low-speed electric vehicles and other solutions that leave minimal impact on not only carbon emissions but space itself. So here are some of their vehicles. Yeah, I mean they certainly have a very nice and sleek website. So this stock is under the megatrends and specifically a theme I call electric vehicles. So you can see here, AYRO, 24% here from the 52-week low, 50% away from the highs. Here is the long-term chart for AYRO. They have actually been around for some time. Not sure if they have been in the same business throughout. To be perfectly clear, this is a bit of a wild card stock. So obviously the bears are in control. The reason why this one popped up on my radar is because we are now at support. Something you can see with this red line. We have clean support back here. That's basically all we have really for AYRO. You also see that with the wicks back here as well. So this is an interesting level. We are testing it right here and right now. It's make or break, and that also means that you can be a bit strict when it comes to stop loss levels. The stock is currently trading at 47 cents. So obviously there's been a lot of damage for sure. When we look here at RSI on the dailies, we are at a key support level on RSI. We see back here, it was support here as well and here. So that corroborates that at least we might get a bounce. Looking at the PPO here, this is the distance between price and the 20-day moving average. Quite a few times this has been a bounce level, but you do see that here it wasn't a bounce level. So that's a bit dangerous. Growing to the green 50-day PPO, it's an interesting level. It just is. But it's make or break. Looking at the weekly data points, pretty far down. Accumulation distribution is not bullish. Definitively have just a big sell-off in the stock. So the thing is that when it comes to this stock, horizontal support, that's what we have. We also frankly have and RSI and PPO, frankly, support. 20 and 50, like that. So a lot of support, a lot of ands with AYRO. So I will give the technicals an 8. To be perfectly clear, this 8 is completely contingent on this horizontal support. And these support levels were also, well, we found horizontal support also on RSI and PPO. If we were to break that, obviously it wouldn't be an 8 anymore. But yeah, AYRO is just technically very interesting. Seasonality, over the last 10 years here in red, there usually is some bullish activity into mid-September before it's given back, which corroborates the notion that we might get a bounce. Looking at the seasonality in the table view for September and October, not bullish. It's not bullish. September is one of the weakest months overall looking at the sum. October, not a big bull either, so seasonality is very much red. So I will give the seasonality a minus. Yeah, I think I will have to give it a -7. This is not good. So really a battle here between the technicals and seasonality. The thing is that given that this stock has been in a massive downtrend over a long period, obviously that is going to mean that the seasonality isn't going to be good really in any month. But yeah. That, however, does not mean that you cannot make money going long AYRO. So if you look at the chart like this, obviously you would be like, why would anyone consider going long AYRO? So let's look at a few times here. 55%. This one doesn't look good. Well, 20%. If you look at this rally here, it looks a bit measly. From this low here to this high, 44%. From this low here to this high, 100%. So with these types of stocks that have seen these massive downtrends, the gains can come, fast and furious. So, it's safer to go long a stock like AYRO than to go short. At least if you are going to hold for multiple days. Yeah. Next, let's look at the seasonality. So you see that we don't have a lot of volume here in the volume bars at this level. So it's relatively dry, even though it has functioned as support in the past. Looking at price book ratio, we are at support. You see support back here, and we are testing that level now. Looking at price to sales here, we also have a support back here and here. So it is an interesting level. We also frankly see this with price earnings ratio, but price earnings it's not that low though. So the case really isn't on price earnings. Looking at forecasts, rather bullish, but we don't have a lot of activity from analysts. So we just have one with the 1 year price target, 176% above us. So fundamentals. I think I will give the bolts a 5 here. I think this is pretty good. These are decent fundamentals. But there is a self-reinforcing effect between. There's it more correctly. There is a dynamic effect between the price of a security and the fundamentals, in the sense that it can become self-fulfilling. So if a stock goes down significantly, then it can be more difficult for that company to not only get new deals between suppliers and stuff like that, and places, and be able to sell their product, because if someone is contacted by a company and then they look at they do some due diligence and it looks like the company might go under due to the development in the stock chart, then they will lose the deal simply because of that, not because there's anything wrong with the vehicles or the price or anything like that of the vehicles, which in turn will affect the fundamentals. So it's rather dynamic, but overall I think it's a 5 at this point. Next, we will look at relative performance. So we want AYRO like that. We want to compare it against DRIV, which is the Global X Autonomous and Electric Vehicles ETF. And yeah, let's just compare it against the number one, Tesla. Interesting. So these are long-term correlations. Minus 19% with S&P 500, 29% positive with the DRIV ETF, and minus 2% with Tesla. Short-term daily data points, then we are at 50% positive with S&P 500, 73% with the DRIV, and 53% with Tesla. So what happens with DRIV is going to have the biggest effect on AYRO. So we see here that DRIV, it's seen a bit of a bounce recently over the last 2 weeks. Dailies, yeah, you can see that we found support here at the 200-day moving average. Seasonality for September is not good. That's not helpful. Not helpful if you are a bull at least. So let's compare AYRO here with the DRIV. Like that. No weeklies. So you can see here as well, in this pair we are at horizontal support. You could also say double bottom. But this is it's interesting. Looking at the RSI level here, and here, it's been a level where we have seen some bounce from AYRO in the past. Looking at the daily data points. Also quite interesting. At this level, you can see we are testing it now here as well. And then you have, yeah, it's an interesting level. Let's look a bit here at the seasonality. Ooh, so for September, it's not green. It's very red. October, November, December also pretty red for AYRO in this pair. Okay. So when it comes to relative performance, um, the seasonality wasn't good, but I will give the bulls a 3 here. There were some other interesting points. So we do end up with 2.3 in favor of the bulls. We are at horizontal support, also support on RSI and PPO. So the thing about AYRO, so where would we put our stop loss? So let's now load AYRO like that. Okay. So we do have a relatively clean support level at the moment. So this is the last price right here, approximately. So 2% stop loss. So looking at closing prices, you could operate with like a 1% stop loss, but you look here at the wicks and you see that there's been some days where we goof around below this, so that in that case you would be stopped out. But if you measure it like this, yeah, to get the wicks out of the way, you would then have to consider a 5% stop loss level. If you were to, go below, lose more than 5%, then we would take out these wicks. And at that point, one would certainly could make a strong case that there's very severe damage to the thesis overall. So the thing is that a 5% stop loss level, it's a bit on the higher end of the spectrum, depending on, of course, on your time horizon. I think that if you consider this a more longer term trade, then 5% is fully acceptable. But for like a short term trade, 5% is definitively not something you want to repeat too many times, because if you have like 4 losers at 5%, and all of a sudden you have 20% that you have to make back, and then it becomes like increasingly difficult. So I actually have a percentage loss calculator here. So let me show you. Like this. So this is the when will I recoup my loss calculator. So if you have like a 5% stop loss level, then you actually need to make 5.26% to break even, in your overall account. So that's a key thing. So it actually is more than 5%. When you get into like 10%, 11.11%, 20% loss, then you need to make an additional 5%. So it is not sufficient to just make 20% on another position. You actually have to make 25%. So 20%, that it really starts to like add up. But if you look at like a 1% stop loss, which is very strict, it's just like 0.1 more, 3%. So it starts to add up. But when you get into something like 50%, right, with a 50% loss on the position, you have to literally make like 100% on the other on other trades. So the percentages to really, it's quite an interesting thing, because if you look at the 90% loss, then 900%. That also means, right, that if you have a stock that increases, then you can really have the math work in your favor, when it emerges from a very low level. So that is one of the reasons, the mathematical reasons, why buy low and sell high works real well, because it's from the low levels. If a stock recently fell like 5%, and then it goes back to where it fell from, then you will make more than 5%, as you saw like with the calculator. And the same thing with like a 10%. If you buy a stock after a 10% pullback, then you're not simply going to make that 10%, you're going to make more. This is a pretty interesting illustration. So You see here from this high to this low, that is a loss of minus 43% almost. From this same level all the way to this high, where we fell from, that is a gain of 74.4%. So that's a huge difference. So buying at the same level this low wouldn't simply mean making 43%.